Hello everybody and welcome. We're just about ready to start, but I'd like to do a quick sound check, make sure that everybody can hear me all right. So if you can please type yes in the question box, that'd be great. All right, fantastic. So let us start. So hi everybody and welcome to Nadex webinar series. We are going to look at strategies for crude oil and natural gas. My name is Tamar Mayer. I'm part of the trading team at Trade with Precision. Now before we head on into the presentation, we need to go through some risk warning and disclaimers. So please have a read through them. Make sure that you agree with them before continuing on to the presentation. So they're going to be two, one for Trade with Precision and one for Nadex, and I'm going to give you a couple of seconds to read each of those. And the second one, okay, so I want to tell you a little bit about Nadex. Well, Nadex is a derivative exchange that is subject to a regulatory oversight by the CFTC. It's newly formed in 2007 and it is based in Chicago, which is the financial heart of futures and options market. Now, all contracts are settled in cash, so we don't need to worry about physical delivery. And there is a wide range of global markets that we can trade on and using two very unique vehicles, the binary options and the spread. A bit about Trade with Precision. It was formed by our head trader Nick McDonald all the way back in 2006, and we have been providing education for retail traders ever since. We also provide international trading training for clients of global brands, and that include exchanges and brokers around the world. We team up with Nadex in 2011, and we are a company that run by traders for traders, and we specialize in trading strategies that are applicable to any market and any time frame. Now with Nadex, you can look to trade on the go, so you can search and filter trading opportunities on binary prices from 0 to 100, gain fast, secure, and flexible access to binary options and spread on most popular markets that are available to you in real time. You can also customize your chart, add multiple time frame and indicators, and view your open position, working orders, and account balance. All right, so what are we going to see on the agenda for tonight? So first of all, we're going to talk a little bit about why commodities, why trade commodities, and how can we take advantage of opportunities in the commodity market. We're going to talk a bit about why is it important to have a trading strategy. We're going to understand a little bit about the technical strategy versus the fundamental strategy. And we're going to look at a technical trading strategy. So we're going to touch in a couple of elements that create our trading strategy, and we're going to see example that just with those several trading, let's call it technical ingredients, we can actually form an opinion or an idea where the market have a higher likelihood of going next. So we're going to learn how we read the chart. So I'm going to show you a couple of elements around that. And then we're going to talk about fundamental trading strategies. So how to utilize news. So we know that news events, they are published in an economic calendar. We know when they're about to happen, how we can utilize trading opportunities around those times. And then I'm going to tell you how you can take your trading further with Nadex. So I'll talk a little bit about the premium education course that Nadex offer to their clients. Okay, let's start with why trade commodities. And by the way, if you have any questions, comments or wonders or things are unclear, feel free to type it in the question box and I'll pick it up as we go. All right, so what are commodities? So first and foremost, let's understand what it is. Well, it's a raw material or an agriculture that can be bought or sold, usually for human consumption. So it comes from wants and needs. Now, we can look at the commodities in sections such as energies, metal, agricultures, and grain in that, and so forth. Now, when we talk about metals and energies, there are changes that happen in price due to supply and demand, economic factor, and also political factors. And we know that that affects, as an example, if we look at the price of crude oil. You know, a couple of years back, it was all about we're going to run out of oil, and suddenly now price was slamming down. So it's all about supply and demand. It's also about political issues. So when there were issues in the Middle East, back a couple of years ago, then the price of oil shot up. All of those affect the price, affect the perception of where the traders think that the market should see the price coming up in the next couple of months or in the next couple of years. So talking about the future market. So the metal and the energy can experience very high volatility. Now that might be a little scary for an investor, but for us as traders, that's what creates opportunities. So what we're looking at, we're looking for market to move. We're looking for market to do big pushes to the upside, to the downside. It doesn't really matter, but to have great rewards from a trend, what we need is volatility. Okay, so the volatility manifests itself in a trend, and these offer us trading opportunities. So let's have a look at a couple of examples. So what we're looking at here is natural gas. This is the volatility in the market, and you can see that on a daily chart, we're actually in a downtrend, and look at the pushes that this market has. Every time we pull back, we had a really strong push to the downside. And when we look at the market over here, we can see that this is on a weekly chart. So obviously as the weekly pulls back, what we're going to see is the daily turning into a downtrend. The 1 hour is in a downtrend. But you can see that over a period of time, we actually get really nice and strong trend. What I've got here is an 8-hour chart, and really it doesn't matter the time frame that I'm looking at. What I'm after is strong established trend. So right here you can see the market was in an uptrend, making clear series of higher highs and higher lows. You can see that on that 8 hours, and the bigger picture is to the upside. And now we started to reverse. We're starting to move lower, and the great trading opportunities as we're moving lower as well. So really it doesn't matter if we move in higher or lower, there's still good trading opportunities. When you look here at silver, what I've got is on the 2 hours, it's a really nice and beautiful steady downward momentum. But actually, I can also look at ranging market, because with binaries option, I can actually look to trade range markets. I can look at this area over here. This is the bottom of the range, and I could assess and say every time the market came down into that area, it actually pushed higher. So it finds its support and pushed higher to the top of that, or the area of the top of that range. So I can look to buy a binary around that area and look to profit from that move. Why can't I do something similar in the traditional form of trading? The answer is because I need to know an exact entry and I need an exact stop loss. And I don't know if the market, and this happens, the market could come down into the bottom of this range, break that, so completely penetrate that area, and then reject it and continue higher. And then I'm going to end up with a stopped opportunity. Now I need to put stop losses because I need to protect my my capital. But I don't know where to put that, because I don't know how far the market could go and go through that level before it finds that rejection. When I trade with binary options, I don't need to worry about a stop loss, because that's incorporated in the product itself. So if I think that the market is going to bounce off that level and I've got a couple of hours into until the expiration of that binary. So even if the market decide to go in 10 pips or 10 points, 15 points, 20 points in and then reject it, I don't get stopped out. So I've got the opportunity to still profit from that trade until time of expiry has come along. So I don't get stopped out. I don't need to worry about the stop loss, and I don't need to worry about preserving the capital, because what I risk is all that I can lose on that opportunity. But we're going to touch more about that in the next couple of slides as well as we go through the examples. So here we're looking at gold, and you can see beautiful strong selling momentum over here and a nice buying momentum right here. And again, these things can change. It can change really quickly. Looking at each and different time frame can still offer us trading opportunities. So sometimes the weekly chart or the monthly chart, they're going to be quite sideways, but as we go lower time frame, we can still find fantastic trading opportunities. So we can utilize different expiration time depending on the time frame that we've decided to enter into the opportunity. So how can we take advantage of this beautiful moving market using the Nadex advantage? So let's have a look. So with Nadex, we can look at two very unique derivatives. We're looking at binary options and we're looking at spreads. They both have very unique characteristics. So let's look at them and have a quick brief what each of them, the advantage of each of them, and what can they give us. So when we're looking at binary option, it basically what a binary is, it's a limited risk derivative where the answer on a question, and the question is the market going to be above or below that price at the expiry date or time? Is it going to be yes or no? So there's no other answer. It either is or is not. So if you think about it, a binary between a 0 and a 1, so the prices is moving between 0 at expiry if the answer is no to 100 if the answer is yes. Basically something around that. Obviously when you're selling, then you want it to be coming closer to the 0. When you're buying, you want it to come closer to the 100. But to understand more about how the binary works, then we do have a special webinar dedicated just for understanding binaries. So but the benefit with that is you can trade with limited risk. So you don't have to worry about slippage in the market or gaps that happens on your trade at your entry, because you cannot lose more than what you've put in the ticket. So when you enter into opportunity, it tells you straight there how much you're going to risk and how much you're going to profit if it goes in your direction. So you can't lose more than that. You also can't make more than what it's there, so it's also a limited reward. You also don't need a high amount of money in the account to be able to trade, so you've got the benefit of low collateral in that trade, and you can take advantage of volatility and flat market, and you've got multiple daily trading opportunities. So you can look at short-term expiration, and you can also look at longer-term expiration, so you can look at a weekly binary as well. When we're talking about spreads, we only talk about intraday trading, so we don't have spread on a weekly time frame. And what it has, it's a derivative that had a built-in it floor and ceiling. So the market or the profit that we can take off that position is only between the floor and the ceiling. And if the market, say I bought that market and it's closed sharply above that ceiling, so the distance between where the market closed and that ceiling, I don't get to make a profit out of that. So there are levels that define the lowest and highest point that this contract can settle on, and you also always know how much you're going to make if it goes in your direction and how much you stand to lose if it goes against you. And it is based obviously on the underlying market, if it be a commodity, an index market, forex market, and so forth. It's also suitable for retail traders. You're looking for leverage, you're looking for hedging opportunity. Again, limited risk, and you don't need a lot of capital to be able to enter into a trade. So it's a leverage opportunity that limit your risk, and you've got, again, multiple daily trading opportunities, but mind you, there is no weekly spread that we can take as we do have with the binaries. So there's fantastic opportunities that we can utilize with the Nadex product. So we can look at if a commodity is moving, there can be a trading opportunity. But you know what? If the commodity is range bound and stuck between levels of support and resistance, there is trading opportunities for us there. Also trading opportunities around news, which is something that usually with the traditional way of trading I wouldn't be looking to do, because I have to consider the risk first and foremost. When I've looked at Nadex product, my risk is already capped, so that eliminate the risk, the part of the risk which is the unknown, where you can look at when you're trading around news. So sometimes if the news are so strong to one side or the other, the market will gap and you'll end up losing more than what you planned for. But when your risk is capped with a Nadex spread and binaries, you don't have to worry about that issue, about that problem. So let's take a look when we can look to trade binaries and when we can look to trade spreads. So it's a little bit about swing trading versus day trading. And the time scale is quite important. So if, for example, I'm looking at a daily expiry and I'm entering off a 5-minute chart, then I might end up losing that opportunity because the time that I've entered into the opportunity doesn't really match the time that I've chosen on my expiry, because if you think about the binary as an example, there is still time value in that option, and if the market reached where I wanted an hour into that day, there's still many hours to go. There's still a lot of value in that option, and I'm not going to end up making a good amount of money even though I predicted a really good move in the market. So we need to be aware what time frame we are trading off and how long do we expect for the market to reach that level versus what type of binary or spread we are looking to take. Binaries are suitable for both swing and intraday trading because we have a weekly binary that we can also utilize. Spreads, they're only for intraday and they have a daily expiration time. So let's take a look at a couple of examples here. So what we've got, we want to trade in the direction of the predominant trend. So we don't want to guess where the market have a higher likelihood of going. What we want is stack the probabilities in our favor. We want to create more and more layers of technical ingredients that will say to us in higher likelihood from here onward the market have a higher likelihood of going higher. So we do have a nice uptrend here. We pull back into this area. We're going to talk more about those technical ingredients a little bit later, but what I'm expecting of this market is a continuation of this uptrend. So what I can do, I can utilize whatever, depending on where I think the market can go. Maybe I think that it will stop at 5, so maybe I can take that binary, or I think that the market is going to go very strong and take the previous high, so I can take the 5.5 around there binary. There's no one there over here, so probably the highest one, which is 5.25, if I think that the market is going to continue all the way high. Or I can look to diversify a little bit and say I'm going to have a small push higher, get me around a 1-to-1, so probably somewhere around this one, and then get a second portion of my opportunity for a further profit taken, so for a higher reward to risk. I can look to utilize that as well. I don't have to choose just one option. Another thing that I can do is I can fade a trade. So basically saying the market came down into a strong level of support and resistance. Every time the market has done so, it rejected that level and then bounced off it. So I can look to trade that bounce off that level. So I can look to say, all right, I think that from here, market hit again the level of support. I think that it's going to bounce higher. Where to? I can look to just take a 1-to-1 out of this one. I don't need a strong bounce for me to get into my target, or I think I can go to the top of that range around the 2160 and I can take a binary somewhere around that. We do need to be able to analyze the chart not only for our entry but also for where do I think the market have a higher likelihood of going. Do I think that it's going to break the previous high? Do I think that it's going to come close to that? Because I need to correctly manage the contract that I'm buying or selling, because it's not only about how cheap that contract is, it's also about what is the likelihood for me to actually reach there at the time of expiry. So I don't want to just buy a cheap contract because that could give me a 20-to-1 reward to risk. I want to get something that has a higher likelihood of actually getting me into profit, even though it's going to be just a 3-to-1 or a 2-to-1. Okay, so I need to assess from the chart where is most likely that the market could go. And if I look deeply into that chart, yes, there is the top level here around the 2160, but there's also this level here around the 2140. So I might not choose to go all the way up. I might say, you know what, I think the market might find resistance or at least stall around that level. Then I will choose to go the 2120. It will still going to give me a really nice reward to risk over here, about a 5-to-1, but I still have a higher likelihood of getting there. So it's all about the balance between the price of the contract versus how likely it is that it's indeed going to get there. So when we talk about spreads and binaries, we do have more options with binaries. There are more strike prices and there are more opportunities for trades. One thing about the spreads, and again, we do have a special webinar to explain more about the spreads, but one thing to know is that when I enter into an opportunity on the spread, I want to be buying at the floor, and I want to be selling at the ceiling, because what it does, it gives me the biggest range that I can get out of that spread for my profit target. Because if, say for example, let's take a look at this one. And say for example, the market currently is sitting around 1340. So what I'm having here is a risk of 40 points for the chance of making 10 points. So I'm actually going to end up risking more than what I can make. That is why when we're looking at the spread, when I want to buy a spread, I want to buy as close as I can to the floor. So my reward is going to be much bigger than my risk. And when I sell a spread, I want to sell it as close as I can to the ceiling, because if the market goes against me, then I don't lose as much, but I have a really nice profit window until it gets to the floor of that spread. So remember, buy close to the floor, sell close to the ceiling. So a lot of the time you'll find that the market is sitting somewhere in and around in between that spread, and you don't find a spread that fully utilizes that power, then I would go for the binary option, because that can give us a better reward to risk. So it doesn't matter if we're swing traders or day trader, trend or fade ranging, then binaries and the spreads are fantastic, solid choices for us. The idea that the risk is capped, the idea that no matter what volatility and chaos can happen in the market, we can only lose as much as we put up, it's an absolute gem. It's so important. Look, the trader number one's job is to look after the capital, is to look after the risk. When we enter into an opportunity, we are opening ourselves for risk. We We know that it's the risk of losing money, but we need to be very rigid about the amount that we're looking to lose. I don't want to lose one time 1%, one time 5%, and then make 2%, because I won't be able to recover my losses. So it's important to look at the same amount each time I'm entering into a trade. Also, situation where the market suddenly had a volatility just erupting out of the roof, then we won't be losing more than what we've put into. In markets that we see, if we think about the forex market, there's heaps of central bank intervention, and sometimes we don't know that these things is about to come. Sometimes we do when we've got the Fed meeting published and we know that it's coming, but sometimes out of the blue there will be an intervention, and suddenly you'll see your opportunity, your trade that's been in a nice profit completely reverse, and 100, 200 points to the downside within a second. If you were to hold that position as a buy or a sell position in the market, you're going to end up losing a lot of money. But it doesn't matter with Nadex product how far in it you are actually, so how far out of the money you're sitting, how far away the entry is from where the market closed, you're still going to lose the same amount, the same set amount, and that is a very, very strong and thing for us as traders. So at Trade with Precision, what we are looking to do is utilize technical trading strategies to enter into the market. So what we do, we look at technical ingredients. So what we want to do, we want to assess the probabilities. We know that the market works in probabilities. We know that not every trade is going to go to target. What we want to do, we want to increase our edge in the market. So we're looking for repeatable patterns. So we're looking for scenarios that to say, if this, and this are presenting itself in the market, then the higher likelihood is that the market is, let's say, going to go higher than sideways or lower from here. And that's what we're after. We're after those repeatable patterns. So each layer of ingredient that we are adding into that pattern, into that layers of technical ingredients, increases the probability that the market is going to go in my favor. So I'm looking at a couple of reasons. I wouldn't just go ahead and say, yep, the market is in an uptrend, therefore I buy it. First of all, I need to ask the question, where exactly am I going to buy it, and what else support a buying opportunity in that area? I don't want to be chasing the market. I don't want to be saying, okay, the market has moved really sharply, now I'm entering, because you know what, higher likelihood the market is going to reverse and just pull back. And this is the natural way of how trend works. There is a push higher and then there is a pullback. I don't want to enter just before the pullback. I want to enter when the market finished that pullback and now continuing into another higher high. So I need to find layers of elements that will stack that probability in my favor. So the trading decision that I make, it's not about, do I have a feeling that the market is going to reverse from here, because that doesn't help me trade. I want to have confirmation from the chart that all these elements are actually presenting themselves. So that is why we're looking at a trading strategy, because it's a set of rules that give us all those elements. So we're looking, as I mentioned, on multiple layers of analysis. We need a point to enter the market, so it doesn't really help to say, okay, I think the market is going to bounce from there. And I give you a very concrete example. I was watching crude like a hawk when it was pulling back into this level. It was pulling back, if you have a look at the daily, at the 8-hour chart, it was pulling back into a beautiful level. And I was after a rejection candle off that level to continue the move higher. I didn't get that. The market actually bounced beautifully from that level. So it was a textbook reaction to a level of support and resistance, but there was no trigger candle for me. And I need to have a trigger candle. I need to have a reason to say, from here onward, the market is going to bounce higher. No, it's not the wrong slide. I'm just kind of utilizing information from what happens in the market right now. So I'm talking about the fact that we need a point to enter into the market, and when we don't have that, we actually reduces the probability of our opportunity. And I was just giving you an example from really today about exactly that. So part of the things that we need to do as traders is to actually, we have a plan. We think, okay, I don't want to chase the market. I want to predict the market, right? That gives me the best trading opportunity. So I'm watching levels. I'm watching areas that I think the market is going to pull back to. There was a really nice, strong push on oil, but the market was overextended. It was coming up closer to 50. There was a higher likelihood of a pullback. So I'm sitting and I'm waiting for that opportunity to come about. The problem is that I don't always get a good entry point into that market. And that was just an example for that. We do need to wait to see some signals from the market that it's actually reversing, that the pullback is ending. Okay, so in your own free time, just have a look at that and you'll see that example. So with a traditional, no need to apologize, all good. In the traditional form of trading, we would need a stop loss, right? We need to protect our capitals. We don't need that with when we trade binaries or when we trade spreads. But it's a good idea to know for a technical reason. The reason for that is if I made an assumption, let's say I made an assumption that this market is going to go higher from X point onward. But what happened is the market went a little bit higher, reversed, and starts to go lower. So one of the things that I can do, as an example, if I see that the market in this regard would have stopped me out if I was in a traditional way, but obviously I'm still in the opportunity because I don't get stopped out. But now the market, what it done, it moves into a downtrend. Okay, so I have two options to do. I can just hold on to that trade and say maybe it will reverse. But you know what? If I see that the market strongly reverse against me, what is the likelihood that it's going to pick up and start going higher again and get me my target? If there is still hours to go until expiry, I can still take that opportunity out. There still might be some trade time value in that option, and if I take it out, I might not lose all of my money that I put on that opportunity. For that reason, and just sort of to understand the technicals behind the opportunity, it's good to sort of think, if I had to put a stop, where would I put it? Just for technical reason. It's not necessary when we trade binaries and spreads. And also managing our profit. So to know exactly where to take profit, sometimes if the market moves really fast into my target and there is another 4 or 5 hours to go, you know what can happen? The market can actually start to pull back, and then I turned a winning trade into a losing trade just because I tried to hold it until expiry and get a little bit more out of that one. So sometimes I can actually put an order in to sell out of that position if I hit a 1-to-1 or whatever kind of reward to risk that I am after. So we need to also be able to manage our trades. All right, so how do we make those trading decisions? So as I mentioned, each layer, each piece of information that indicate that the market has a higher likelihood of, say, going higher instead of lower, increases that probability. So we have sets of rules, and those rules give us our edge in the market. We need to define those edge or those rules in advance. And we also need to understand that on a trade-by-trade basis, the probabilities of win and loss are 50-50. But when we think about a large sample sets of trades, this is where an edge comes to play. So when we have an edge in the market, it's not about the one current trade that we're taking right now. It's over a large sample sets of trades. And understanding that help understand the whole probabilistic nature of the market, because we never know which is the trade that's going to go to target and which is the trade that might end up at a stop. Okay, so when we look at technical strategies, it's basically evaluating the price action. It's looking at the price action and say, adding some indicators, adding some oscillators, whatever we like, but it's basically the analysis of the price action on the chart. When we talk about fundamental analysis, it's really everything to do with anything but the price itself. It's supply and demand. It's about political and geopolitical reasons. It's about how would other events in the world could affect the price of this commodity or that commodity. So even weather events, all sort of things like that can affect the price, and we're looking at information to help us assess what do we think is going to happen. For example, when we have the publishing of inventories numbers, that also push the price higher or lower depending what the inventory result was. That fire that was in Canada affected the price of oil because suddenly there's fears of not enough supplies. All sorts of events like that, they can affect the price action. So when you look at technical ingredients, you don't really look at those fundamental reasons, although I do think that marrying the two of them, so having an idea of where the fundamental is and also looking at the technical ingredients can really create a strong trading opportunity. So looking at the market, and there's all sorts of situation fundamentally that happens, and the markets now pull back into a really strong level. What those two starts to work together into a very strong trading opportunity. So to me, they don't live in a separate universe. They are really connected, the two of them. But we don't have to utilize fundamentals for technical ingredients. So what sort of ingredients are we looking at? So let's take a look at a couple of elements. So there's more elements to it, and we're actually teaching all of them and in a bit more details. I'm going to run a little bit quickly today. We don't have a lot of time, but we do teach all of that in the advanced course that we do for Nadex. So if things are a little bit unclear today, as long as you're a Nadex member, you can join us on that free education course that we do. Okay, so the elements that we have are first, optimal chart structure, price action trends, moving averages, patterns and zones, and true levels of support and resistance. So let's understand what is optimal chart structure. So what I've got here is a beautiful uptrend. We've got a clear series of higher highs and higher lows. We don't have any uncertain or erratic behavior. We don't have gaps. We don't have big wicks on the candles, so big indecision candles as well. It's very much predictable, and you can see that as the market making a higher high, I've got an expectation for a higher low, and on we continue. You can see it's a very nice and steady buying momentum. When we see this sort of charts, that smooth flowing action, it actually increases the probabilities of our opportunity hitting target. We don't have those erratic indecision candle that suddenly 2 seconds before expiry, and here we go slamming down before our expiry price, before our strike price. So we've been in profit all through and through, and suddenly bang, it falls below. That doesn't less likely to happen when we have nice flowing momentum in the chart. Now, when we look at charts like this, you know what? In anybody's guess what this market is about to do, because we were in a sideways action over here. We started to move lower. Now we started to uptrend, and now again we put another lower high on this market, another lower low. The big picture right now is who knows where this market have a higher likelihood of going. Even if I was to look at it as a range, then the top of the range sits somewhere around here, around the 90. The bottom of the range is around here, somewhere around the 87.5. And right now I'm sitting somewhere in the middle of the range. Where I'm in the middle of the range, to me, it's 50-50 if the market is going to come down to the bottom part of the range or up to test the upper part of the range again. I like the market in either side of the range. I don't like the middle part. So right now, even as a range-bound strategy, I don't have any clear confirmation. Is this going to go lower or is it going to go higher? Or it could even go sideways. I don't know. There's no high likelihood. And if I don't know, then that reduces the probability of hitting target. So what about this chart? Well, why don't I like this chart? This chart is very gappy, meaning between the previous period close to the opening of the next period, we have a massive gap in the market. And say, for example, you wanted to buy this market and you were in a weekly opportunity as an example, and everything looking really good for you, and suddenly, bang, the market is falling so further away. When you see a chart like that it happens a lot, it could also be because there's less liquidity or something is going on. But the idea is, again, it reduces the probabilities of the opportunity hitting our target. When we see a chart like this, and even though the momentum in a way is to the upside, it is very erratic. It is very ugly, because what I've got here is these really, really big candles, okay? And I can see, look at these candles over here, moving all the way up and rejecting it. And this one, all the way up, rejecting, coming all the way down, rejecting. There's a lot of indecision. All these big candles, all these big wicks are not in our favor when we're looking for an opportunity. You know, there's this saying that when amateurs control the market, we see big candles, and then when professionals control the market, we see small candles. So we want to enter on small candle and we want to exit on those big candles. But when we see a chart like this that goes, you know, sideways with big candles all the time, there really is no trading opportunity that give us an edge in the market. So it's not about guessing and having a 50-50 chance. It's about increasing our probabilities. So let's take a look at this one. We've got this bearish price action over here. This is beautiful. There is no uncertain behavior. There is no erratic behavior, no extreme buying or extreme selling. What we've got is just smooth, nice price action, clear series of lower highs and lower lows. And this is quite similarly the optimal chart structure for a bullish price. So a clear series of higher highs and higher lows, no erratic or uncertain behavior, no big candles, no gaps, no big wicks, just really beautiful, steady, smooth buying momentum. Okay, so we talked about optimal chart structure. The next thing that we need to look at is the trend and the price action on those trends. So we know that price doesn't move in one straight line. We know that every time there is a push higher, as an example, for whatever reason, be it profit taking, be it that there will be some people who would say this price is too high, therefore I'm going to sell here. For whatever reason, price is pulling back. So the price is working in a wave, okay, when we have waves of buying and selling. So we're looking at retracement in the market. So when we're talking about a trend, we're looking at those higher lows and lower highs in a trend. So when we're talking about an uptrend, let's just define it. Clear series of higher highs and higher lows. When we're talking about a downtrend, clear series of lower highs and lower lows. When we don't have a trend, it's anybody's guess where the market is going to go next. Now, the market already works in probability. I can have the most beautiful opportunity out there and end up at a stop, right? So I don't want to increase the probability of my trade hitting the stop. So I want to trade with the highest likelihood as I can. If I don't know where the market has a high probability of continuing from here, if the market doesn't know either, because this could just complete on going crazy here, doesn't know if it's making higher highs, higher lows, where exactly is this market going to go, it doesn't increase the probabilities of me hitting target. When I look at an example for, let's say, downtrend, when the market is making lower low, pulling back to make another lower high, until I see a reason that this market is running out of momentum, that this market is running out of steam, then I have a strong expectation that this market is going to go ahead, break the previous low, and give me another lower low. That's a strong assumption to be trading with, where here I don't know what's going to happen next, so I don't have that strength of that momentum with me. The next thing that we want to add into that trend is the moving averages. So the moving averages, they're smoothing out the price action, and they're averages over the previous period. So we're looking at the 10 and the 20, which are the short-term moving averages. We're looking at the 50, which is the medium term, and we're looking at the 200, which is the longer term. Now, what we also do with this one, we want to know that we have a strong geometry between those moving averages. So we want to look at the moving averages and say, are they in the correct order? Meaning, for an uptrend, the 10 above the 20, which is above the 50, and also if I get it above the 200, that's fantastic. For a downtrend, the 10 below the 20, below the 50, and hopefully below the 200 as well. For the 10, 20, and 50 to be in the correct order, that is a must for us. The 200, it's nice to have, it's not essential. It's basically saying to me the longer term trend is in agreement with the shorter term trend. But what does this give me? It gives me an understanding over the strength of the trend, because if the moving averages are squished, if they cross to the wrong side or to the wrong order, that tells me that we're running out of steam on that market. So I want to have the correct geometry. I want to have the moving averages also fanning, and I want to have a space between them, because that's indicate strength in that market, in that momentum. Now, I also pay close attention to the area between the 10 and the 20 moving averages. So we call it the equilibrium area or the precision area. Now, what exactly is that? When we're trading and we're looking at an uptrend or a downtrend, when we have a push higher, what happens in the market? The market moves away from its moving averages, what we call overextended. Once the market is overextended from its moving averages, we see a higher likelihood that this market will pull back into that equilibrium area and into that precision zone. It's sort of think about it as if you throw a ball up in the air. So when you throw it up, there's a lot of strength in that, and the ball is moving sharp and strongly higher. At some point, the ball is going to stop, so it's going to halt and then reverse and fall back to the ground. And this is sort of what happened with the market. We want the market needs to come back to its balance point, to its equilibrium point. Now, when the market starts to move further and further away from its equilibrium area, we don't know when exactly the turnaround is going to happen, but we know that there's a higher likelihood that it's going to happen. So I don't want to be, let's say, buying somewhere around here. So the mistake of a lot of new traders is that they see this big, strong, bullish candle and go, I want to be a part of that. So they jump in and the market have just a tiny little bit in it to push and then starts to pull back. The reason for that is that big overextension that we've got here. So what we're doing, we're saying, okay, beautiful uptrend. I want to be a part of that, but not just yet. This is too overextended for me. I'm going to wait for the market to pull back into the buy zone, and when the market is sitting around here, meaning that it releases some of that buying pressure, there's some selling, some profit taking happened, I can look to take it to the next higher high. So I'm not looking to buy here because I get excited that this market showing some strong push to the upside. I'm actually waiting for the market to pull back, and this is part of what we need to do as traders. Even if we identify the most fantastic opportunities, the most fantastic sort of trend, sometimes the market is not yet offering us an opportunity and we need to wait for that to come to us. And this is exactly what happens here. The market is pulling back, getting into the buy zone. We've got a nice bullish candle sitting here in the buy zone, a break above it, and a beautiful continuation to the upside. Quite similarly would be the sell zone. So the market is in a downtrend, and a pullback into the sell zone means a bit of release of that selling pressure. That's going to be the next lower high. So that's what we're after really in that trading strategy, is to identify the next higher low and lower high in the market. Now obviously that doesn't work 100%. Sometimes you can get a situation where we pull back, move slightly, and then push lower again. anything can happen in the market, but we're looking for repeatable patterns, and we're saying where is the most logical place, as an example, to buy into this market? Would that be here when the market is further overextended, or would it be here when the market has pulled back into that equilibrium area? So this is how we increase our probabilities. This is how we stack those probabilities in our favor. So the next element, excuse me, is support and resistance. So what we're talking about is true support and true resistance. Oh, there's a question, sorry. Are you able to show how to create the buy and sell zone? Yes, of course. So we just colored them here, but we don't need to color it. But what we've got here, this is the 10 and this is the 20 moving averages. So all you have to do is just add them to your chart. So what we've got 10, 20, 50, and 200. You add them to your chart, and the area between the 10 and the 20 moving averages, these are the equilibrium zones, so the buy zone or the sell zone in a downtrend over here. And by the way, you can use simple moving averages and you can use exponential moving averages. It really doesn't matter because we're not looking at moving averages crossover, and we're not looking at excuse me, we're not looking at you know, price touched the buys, the 10 moving averages, therefore we have to buy or we have to sell. We're looking at a zone. So it can be a little bit above the 10 and a little bit below the 20s, and that is why it doesn't matter if it's a simple or an exponential, okay? Because it's a zone around the 10 and the 20. Make sense? Cool, fantastic. All right, so talking about support and resistance. One of the troubles with support and resistance is when we're looking at sloping trend lines. When we look at sloping trend lines, what we're doing, we're connecting highs and lows in a trend. Now, which high exactly do you connect with which high? How far back are you going? Do you connect it at the top of the line, at the bottom? Where exactly do you move that line? Another problem with that, if you have a big screen computer, you get more information on that computer, more data. So you get to see different highs and lows. So you probably connect different highs and lows. If you look at it on a small screen or even on your mobile, then you'll find that you see less data. You might connect different highs and lows. And then the problem is that sort of subjective support and resistance is not something that I can rely on. The whole reason why I can look at those support and resistance and rely on is the fact that not only do I see those levels, but everybody else see that level. That's how reaction to those levels happens. So when we look at support and resistance, what we're saying is we want a flat level with clear touches on that level. So for example, have a look here. We've got the market coming up, touching that level, falling from it. Coming up again, touching that level, and look, it can be within a few ticks or pips or points, but visually it needs to look like a touch. And you can see that when you look at it, you can see it's pretty close to that line, so I'm quite all right with it. And the market fell from it. Come up again, there's another touch over here, and the market fell from it. So what I'm looking at is those touches in the market, those market coming up into a flat level and then rejecting that flat level and falling from it. So as resistance, it's touching within a few ticks or pips or points, obviously, touching the same level above, and with support, it's touching the same level below. So when we're talking about those levels, what really happened around those levels? Well, when a lot of traders see the same levels, there are expectations for things to happen around that level. So let's say in here, I was a buyer in this market, and I know that there is a level coming up above. So I might say, okay, I've got good profit over here. I don't know if this market is going to break this level or not. I'd rather be out before the market gets here. So I'm going to put my selling order somewhere around here and exit my position. Now let's say I wasn't a buyer of this market and I've noticed that there's a strong push to the upside. Market is hugely overextended, and it's coming into a level of resistance. So I'm thinking, what's the likelihood of the market actually breaking that level and continuing? I actually think the market is going to reverse, so I'm going to put my selling order somewhere around here. So there's a cumulative of selling order in and around that level. Remember, everybody's seeing the same level. And then the market gets here and all those selling orders are being triggered and the market has a strong reaction to it. That is why it's important to see what everybody else is seeing. It's not the time to be unique. You don't want to be the only one buying when everybody else are selling. So identifying levels of support and resistance can absolutely increase our probability hitting target. So there's two things that we want. We want those levels of support and resistance to either be protecting our entry, and also we don't want them to be as an obstacle in the way of my target. So say for example, I was to enter at the break of this candle over here. There's not much that I can get out of this market before I enter into that level of support and resistance area. So there's not enough for me to get my reward. This is not a good trade. So opportunities that otherwise will be absolutely fantastic, if they don't have enough room to move, they're not going to be good enough opportunities for me because I can't get a good reward to risk out of that one. Now, a nice thing about levels of support and resistance is that support, once broken and tested, become resistance, and the resistance once broken and tested, higher likelihood obviously becoming support. So this is a huge assumption into the behavior of the market, because if I know that the market, say for example, pull back into that level, and now you can see this resistance right now. We find that resistance finally broke up and then pulled back into that level. This could be a fantastic trading opportunity for me. And again, you can see that here, a pull back into that level, a pull back into that level, and a move away. And right now, once we broke down through this level over here of 102, the market is pulling back into that level again, looking for an entry as the market finds resistance around this. Now, obviously, at some point those levels are getting broken, so we need to add more and more layers to say, yes, the market have a higher likelihood of finding support and resistance there, so we can't just jump into the trade because there's a level. But that really strengthens the chances of our opportunity hitting target. So having our stop protected is a really, we don't need a stop here, but having the market protected from, let's say, for example, here, going higher and actually finding that resistance and going in our favor, that's a huge additive to our trading opportunity. So major levels of support and resistance attract a lot of interest, and that's why the market reacts to those levels as well. All right, so now we're coming up into how to take all these elements that we ran through right now and combine them into some technical ingredients. So what I want to do, I want to take a couple of minutes break, let you digest a bit of that material. If there's any question about what we've seen, feel free to type it in the question box during the break. I know that sometimes when I keep on talking, it's a little bit hard to type and listen as well. So this would give you a good opportunity to type the questions. We're going to take about 8 minutes break. It's 3 minutes past the hour. Let's come back, 57 minutes past the hour. Let's come back at 5 minutes past the hour. I'm going to put a little clock as well so everybody will know when we're coming back. Where is it? There we go. So here we are. And I'll see you back in 8 minutes. All right, welcome back. So I got a question if you can get a recording of this. So yes, this has been recorded. I'm not quite sure what the what's the admin around the recording. So I think the best thing to do is actually contact Nadex about that. But it is being recorded, but I don't know if there's, I think some of them were shared on YouTube. I'm not quite sure, so better to contact Nadex directly about that. All right. The 10 and 20 you referred to previously, are they defined by different names as well? No, they are moving averages. So you'll find simple moving averages and exponential moving averages. And sometimes you'll find it EMA and SMA. But they are moving averages. They don't have different names. Okay. All right, so let's move into the technical trading strategy. So let's take all of the information that we looked at and sort of combine it all together. So this is the beginning of a trading strategy. It's not all the elements that we've got, but there's a couple of elements that just by having those, you can, every element, every rule increases the probability. So obviously we want to have as many as possible that also keep it quite simple too. So we don't want to make it too hard, but we want to make the probability of the opportunity hitting target as high a likelihood as possible. So first thing, we want to locate a chart with optimal chart structure. We're only going to trade in the direction of the trend. We want to have the moving averages fanning and in the correct order, so having the correct geometry. We want price to be pulling back into the buy zone or into the sell zone. And we want to see either a bullish candle in the buy zone for an uptrend and a selling or a bearish candle in the sell zone for a downtrend. We only want to see trades that we can get at least a one-to-one reward to risk. I mean, this is from a reward to risk point of view. Yes, you can absolutely get opportunities that have less than a one-to-one, but if you think about the fact that the market works in probabilities and not every trade is going to hit target, it's already a little bit against us. So we need to think about a good reward to risk. I mean, we don't want to have a strategy with an 80% win-loss ratio and end up in the red at the end of the day. So we really need to think about reward to risk, and what we're looking at is at least a one-to-one reward to risk. And to add more weight into our trade, have it bounce off a level of support and resistance and not having it in the way of our target. So let's take a look at a couple of examples over here. So looking at the 4 hours chart, you can see really nice uptrend pulling back into the buy zone, bullish candle in the buy zone and a move away. Looking for something similar at that time. Now take a look here. What we've got here as well is also there's a couple of touches, a move into here. It's going to be quite nice. Looking at the 2 hours, you can see that the 2 hours is already back in the buy zone. We've got a bullish candle here in the buy zone, and looking, you can see a lot more clearer the touches on this level. So we've got a touch here and another touch over here, and you can see that the market actually found support at this level. So looking for another higher high. Moving averages are fanning and in the correct order, and we have a nice steady bullish momentum to this chart. So I like this market and I look to take an opportunity to the upside. So let's see what else do we have on that market. So if I'll take the fibs of this previous move, I can also see that I'm pulling back into 50% retracement, which is sort of like it's a halfway of the move, and what we're looking at is what we call the sweet spot, which is the area between the 50 and the 62%. So we like it when the market is pulling back into the sweet spot, and then that's going to be in the sell zone or in the buy zone, and then have that moving, because we had a bit of release of that buying or selling pressure that we had. So on the 4 hours, this will be really nicely in the buy zone. So looking for that push, looking for that movement. Now, when I'm looking at this area, I want to see, what sort of contract can I look to enter with, and I can look at these levels over here and I can see that a contract that is not too far away, I can actually get almost a one-to-one out of that one. The next contract up, it's going to be somewhere around this 3.2 to 1 or something around that. So I don't need a huge move in the market until I get those 1-to-1 and 2-to-1s. and also look at the time that I've got to do so. So I'm looking at 2 hours, 4 hours type of opportunity. I've got about 17 hours left to go. I actually think that I can get there and I can actually go ahead and take the previous high and even continue in higher. But I'm quite liking the fact that I don't need to take too much in order to get to my target. So 17 hours on a 2 hours opportunity time frame is quite a good one to continue with. Let's have a look at another example. So looking here at natural gas, and I'm looking at the 4 hours, and we're in a downtrend. Moving averages are fanning and in the correct order. You can also see that the longer term trend is in agreement with the shorter term trend as well. So the overall long trend is also in a downtrend, which add strength to this opportunity. Now we're pulling back into the sell zone over here. Let's take a look at the 2 hours. So the 2 hours also have got a nice small bearish candle in the sell zone, and right now I've got a break below it. So what I've got is a confirmation of a lower high right here. So looking to see how further can I take this market and what sort of a vehicle can I look to do that with. So if I'm looking here at the spread, so I'm looking at a 2 hours opportunity. So obviously I'm not going to take something that is about to expire, let's say in the next 2 or 3 hours, but I'm looking for a nice move, at least to test this previous low. I can actually look at some spreads over here. So this is the spreads that are available to me. So what I can do with this scenario is I can actually say, all right, the market sits here around 44.3, let's say 9, in around that. So I'm looking at this area, and if I'm looking at here, this is sort of in the middle, and remember, I want to sell at the ceiling, I want to buy at the floor. So here I'm looking to sell the market. So if I'm looking at this one, we're actually going to be somewhere in the middle. So approximately I could get a 1-to-1 out of that one. But if I'm looking at this, so I'm actually pretty close to the ceiling right here. So this is 4.4 and I'm looking at 4.385. So I'm pretty close here to the ceiling. I'm looking to sell from here and hopefully get my profit all the way down. Even if the market sits somewhere around here, let's say this is the 4 level and I'm not getting all the way down to the 3.9, I'm still going to get a nice reward to risk out of that one. So it's always important to have a look at the differences at what we've got between the reward and to the risk. We don't want to have a risk that it's much greater than how much we might be able to make from that opportunity. Okay, so what I want to do now is talk a little bit about fundamental strategies and how it can help us utilizing the Nadex vehicles to look for trading opportunities. So usually, I will not look to trade news. Things like even non-farm payrolls, GDP, interest rate decision, Fed decisions, when they publish the meeting, they have a high impact on the market. Now, even if you perceive the impact in the correct direction, what can happen is the market would weak, and sometimes you'll find, let's say you're thinking the market is going to go higher. Let's take as a concrete example the US dollar when we had the release of the Fed meeting 2 days ago, I think. So the market was already in an uptrend, or there was already seeing strength of the US dollar in the market. But what we had, when you look at it, you might, even if you were long that opportunity, when news have been released, sometimes there's like a dip for a couple of pips and then the market keeps on moving. That dip can take you out and can increase the risk because it happened in a fast market. There could be slippage as well, and there could be caps as well. When we're looking at Nadex contract, we don't have to worry about that as long as the market end up in our direction at the time of expiry. I don't really care how many times it went below my entry and up and below and again until it finished where I wanted it to finish at expiry time. So it's something important to remember. So what sort of economic news trading can we look at? So things like that have, as I said, non-farm payrolls, it's something that I would look to do. GDP releases. But inventory, when we talk about inventory numbers and all sorts of things like that, they would affect. If you think a couple of weeks back when we had that summit, that OPEC summit in Saudi Arabia, I think it was, and no, in Qatar, and there was an idea to stop the price of crude from going lower, and there was an expectation that this is actually what's going to happen, and this was the price, and the price came Monday open because they couldn't come to an agreement. The price came open quite lower before that. So if you are thinking about news, now that sort of news was on a weekend, so it's very hard to trade, but because the market already opened in a gap. But when you think about situations like that, you can take a political view, you can take an understanding, okay, the market probably they won't make a decision because Saudi Arabia and Iran don't want to agree, and this is where the problem started, or there could be an agreement, or maybe Russia wouldn't be happy with that. All sorts of geopolitical situations like that. You can take that view and you can place it as a trade. You might say, okay, I believe that the oil prices is going to go much higher because of all that diversity that they have, all that agreement and cutting production and all that. Or you can say they're going to go ahead and go do on purpose to one another, and everybody is going to keep on pumping more oil, and then we're going to end up with prices going down. So it's sort of like an assessment from a fundamental point of view. What do you think the underlying market is about to do, how it's going to react to those news? Now, we need some sort of timing for release of that news, because you can take a view as a weekly, but then you're running the risk of up and down and up and down in the middle, and you might took the right view, but somewhere during that week the market retraced and you end up with expiring worthless. So if we are timing correctly the news and our opportunity, then sorry. So if we're timing correctly our opportunity with the timing of the market, then what we end up with is we can enjoy that big push that happened as a reaction to the news, and then we can get out of that opportunity before it starts to reverse on us. Okay, so we need to understand that fixed timing. We need to be able to look at a calendar. So we have to look at it. We can't sort of go, okay, I think that today the market is going to go higher. We need to see a reaction to some sort of piece of news. So get yourself acquainted with whatever economic news you like to look at, and have a sort of an understanding what would the meaning be of that release of that news. What happened if the supply level are much higher than what was expected? What happened when the supply level are much lower? So looking at that, and also compare it to the technical moves that happens on the chart. So say, for example, we're about to have release of crude oil inventory, and the market has pulled back into a strong level, and we're thinking that we're going to see some decline in the inventory because there was a fire here and disagreement there. Then I'm actually thinking we're going to bounce off that level. So I can look to trade that belief, utilizing what I think is going to happen from the fundamental point of view, and utilizing it with a level of support and resistance that, say, the market is sitting on right about now. So we can look to combine the two of them together. So the news event is it sets at a given time. So again, if I take a contract that is going to end up expiring in a couple of hours time, let's say 16, 17 hours, I might not end up with a profitable trade. What could happen is the market is going to short up as a reaction to the news, and then I'm going to get my targets, but then slowly starts to drift. Because remember, think about overextension. It doesn't matter what pushes the market into a huge higher high, it is going to pull back. There is going to be some profit taking. There is going to be a pull back to back into the equilibrium, back into that precision zone. So even if it's going to drift slowly, it might at the end of the day end up expiring worthless. So we need to be very careful with the timing that we take our contract. Okay, we need to think about more favorable reward to risk, but we don't want to buy the cheapest contract out there and then running the risk of actually not getting there. Okay, so we need to be thinking about where would be the likelihood that the market is going to get to, what sort of place would be a good target, and then choose the correct contract. So if you think about the announcement of the inventory for natural gas and crude oil, that happens half past the hour. So if I'm trading a 30 minutes contract, that allows the market to actually react to the news, get there, but I might be able to expire before the market starts to have that pullback. I can also look to manage my opportunity, so I can say, right, I got to where I wanted, I got my profit, let's say it happens within 2 minutes. Do I want to stick around and wait to see if it's pulling back on me, or am I happy to exit that opportunity right now? And sometimes that's not going to be a bad idea. You know, you lock in your profit, everything is good. You don't have to wait for expiry. You can always lock in your profit ahead of time. So trading around news is quite volatile, so we might see reversals and quick reversals if the numbers, they don't match what the expectation happened. We could see reversal in the trend, or we can see continuation in the trend. We could see strong level of support and resistance broken, or we could see them being respected. So it's not a definite kind of an opportunity. Just like with everything else in trading, it's all about probabilities. Okay, so we're looking for a reaction to those news. So if we are adding technical ingredients to the fundamental ingredients, that can help us increase the probabilities. There are a few more technical ingredients that we haven't had the chance to cover here today. So things like divergence and convergence. So they talk to us about the strength of the trend itself. So the moving averages, they tell us what happens in the trend right now. Has it been strong up until now? The convergence and divergence tell us what's going to happen next. So is there's a higher likelihood of a next higher high, or there is no higher likelihood of a next higher highs. Levels of support and resistance, they can support our entry, but they can also stop our target. So we need to be very clear that we're not entering just shy of a very strong level of support and resistance. So I want to show you a couple of examples how we can utilize that. So looking here at natural gas. Now, what I've got here in this area on this daily, I've got a small bullish candle here in the buy zone. If I look at this time frame, if I look at the 8 hours, this candle is way too big. The problem with big candles is wasted momentum. So remember, we want to enter on small candles and we want to exit on those big candles. So I'm looking at a time frame that will give me that small bullish candle in the buy zone, and we have that freedom to change between the time frames. So we're not locked to one time frame. If the 2 hours don't give me a good opportunity, if they're too deep outside the buy zone or the sell zone, if the candle is too big, then I can go to the next time frame up. I can go to the 4 hours, I can go to the 8 hours, whatever give me a better entry opportunity. And then I look at confirmation from the next time frame up. So I can look for the better trigger candle across multiple time frames. So here I like the daily because I've got a nice bullish candle here sitting in the daily. So let's see what sort of ticket am I looking to take out of that one. How far do I think this market have a likelihood of going? I have an assumption that this market is going to go higher. Look, we can see that from here there is some bullish momentum to the upside. There is a little bit of a level sitting around here. Probably I would look to see if I can take it at least to the top of that area, so at least to make an equal high. So when we look at the tickets, we've got a couple of strike prices to look at. Now, when we think about the strike prices, look, this one gives me about 2.3 to 1, somewhere around that, 2.5. This one can be a really, really nice This is, yeah, 2.2 around something like that. This one will give me about 5-1. And you're thinking, wow, this is a really, really good opportunity. But mind you, I need to be able to get there in a specific time, and not always the cheapest contract is going to be the contract that's going to make me the most money. Sometimes we're not going to get there, and it's going to expire worthless, and then I lost on that opportunity. So we have to think about how far do we think the market can get? Is there a level in the way of the target? And am I happy with a lower reward to risk, but still a profitable trade? So let's see what happened. So the news release came out and the market shot up. Now the market currently just above that level, right? And it's massively overextended, okay? You can look at our ticket of 46.50 over here. We're actually reached a 1-to-1, a little bit more than a 1-to-1. So what I could do in this scenario, I could actually say, you know what? I could put an order to exit that, so put a limit order there to exit that once it hits a 1-to-1, so it automatically takes me out and I made my profit. Or I can say I can go out now, or I can say I'm willing to hold it until expiry. The problem with this one is that look how overextended the market is. You know, we had a really, really big push. What's the highest expectation that the market is going to do now? Continue higher even further, or you know, starts to pull back? And it doesn't have to pull back a lot. It could just sort of like swing lower, tiny and comfortably right now after having this really big push. Even a small smooth push lower can reduces my profitability. So if I took the 47.50 contract, you know what, I might be at break even. I won't be making much money out of that one. So even though this contract was cheaper, this contract actually made me money. This one made me a 1-to-1. Here, all that I am is breaking even. So not always the cheaper contract are the one that's going to make us the highest reward. As you can see in this example, it didn't. This one just got me into a break even. This one got me my target. Any questions about that before I move to the next opportunity? Okay, let's continue. So let's see what I've got here. So I'm looking here at crude. This is the daily trend. Obviously, it's a little bit of an older example, but it doesn't really matter. It is an example of a chart. So we're looking here at crude, and crude here is in an uptrend, pulling back right now into the buy zone. There's a nice solid uptrend and a quite predictable price action. Mind you, there's one thing that I want to add into the levels of support and resistance. We do see that round numbers do offer us nice levels of support and resistance. It's a more of a psychological thing. We look at numbers with a lot of zeros next to them, and they look quite bigger. Think about you know, when you go to the shops and everything is 10.99 and 9.99 and all that, but it's never 10. You know, they're never rounding it up. It's the same thing with the market. It looks like 101.90 is not as high as 102. And if you look at the market, look at here, you can see right here, maybe I'll just draw this as a line. You can see here, not a very strong straight line, but you can see this is where all these touches are 102. And you can see here, this touch over here and this touch over here is the 104. Okay, so levels around round numbers are also level added value of levels of support and resistance. It just increases those support and resistance level. It's a psychological level. There's nothing else added, but it's nice to see the market pulling back into a round number and a continuation. So when you look here at the 8 hours, what the 8 hours is doing is from the 8 hours, if you remember, stick back into the daily. The 8 hour, when we looked at the daily, we didn't see anything at the 1.03. Okay, that action was smooth. As we go down the time frame, you can see that 103, again, touches here and another touches here. So another round number, another level of support and resistance. So what we did we bounced from a 103 and now we're pushing into 104. So we are finding resistance at this 104 level, but we're looking quite strong and we're looking quite bullish. Let's move down the time frame into the 4 hours, and you can see again this level, the 103, it's been quite strong, couple of touches, and on we move away. So we're looking at the break of the high of this candle for a continuation of this strong move to the upside. You see the moving averages fanning and in the correct order on all time frames, even the 200 moving averages on the daily. What does it tell us? It tells us that the longer term trend is in agreement with the shorter term trends, which push or which show us strength to the upside. So now let's move into the contract. So I'm looking at the contracts that are available to us. Now remember, what I'm looking at a push higher, but I'm also expecting a break of the 104 level in and around that. Let's come back, and you can see that the previous high is a little bit above the 104. So somewhere around 104.30, something like that. We do have one touch as a 104.50. If I go back into the daily, you can see that the daily, after it's pushed back into the buy zone, I'm looking for a continuation higher. And really from an uptrend expectation, I do expect the market to go ahead and break the previous high and give me another higher high. So that's an expectation from the daily point of view. Now, we're looking at how long it is to expiry. We've got here 2 days. So the assumption is, what is the likelihood of the market getting the 104.25 or the 105.25? All right. Now, if this was the Monday, probably the 105.25 would have a high likelihood of reaching, because I'm looking at a very bullish chart, and also I'm looking at an expectation to break the previous high and give me another high. Maybe there will be a pullback, but there's enough days, enough probability that this could happen. I've got 2 days left, and really what I want to do, I want to lock in profit. I don't always want to take the most cheaper contract and running the risk of actually not getting there. So it's a fine balance between how much profit can I look to take. So I don't want to take minimal profit. I definitely don't want to take anything that is less than a 1-to-1, but I also don't want to rob myself of good opportunities that I could get a good target and then I ended up with a losing trade just because I chose the wrong strike price. So let's have a look at the result. And what you can see in this one ended up in a profit. We're sitting above that level. We're looking quite comfortable. This one right now, because we don't have a lot of time left, all that this one has is the time value in it. What's the likelihood that the market is actually going to go another 50 points and entering into that, getting this to become expire inside the money, so in the money? If you can look at this, we're already overextended right here. We're finding some sort of support here. What's the likelihood of us being able to do so? Probably not as strong. So this one is going to expire worthless, where this one is going to leave us in a profit. We can either look to take profit, or we can take half of the position in, take it at 1-to-1, and leave the other one to see how it expires. Why do we do that? Say I sit in a situation where, look, there's about 3 hours until the market expires, so until the options expires, not the market. I'm overextended. I'm still sitting good amount of points above my expiry strike. Okay, so I'm feeling quite good about it, but you know what? Things can reverse, and can reverse quite quickly. So I have this decision. Do I want to take profit all through and through, or do I want to leave it there to expire and see what happens, so take my chances? I need to make a decision here. Now I can do two things. I can either take all of my position out and then lock in the profit and be happy, Or I can say, I don't think the market is going to move a lot right now. I think it's going to stay here. I'm willing to take the chance. Or I can say, how about I play both of those scenarios? What I can do, I can take half of my position, so half of my risk. Let's say my risk is $100. I can take $50 out at 1-to-1. So I can close out, let's say, 2 contracts, 3 contracts, whatever that equates to in that opportunity. I can take them out. That means a locked-in profit of a 1-to-1. Now, if there was a sudden move in the market and this one expired worthless and I lost my stake, then what I end up with is a break-even trade. Okay, I made money on half of the position. I lost money on the second half because of that situation that the market reversed. And I ended up with a break-even trade. So I haven't lost anything out of that one. If I leave the whole position in, I run the risk of taking a winning trade, turning it into a losing trade. If I take out all of the position, then I'm only locking whatever I can lock when the market is currently right now, about a 1-to-1. But if I take half at 1-to-1, I still leave a couple of contracts, I still leave half of my position in a good point to make me more money. So I not going to lose anything because I already cleared half at 1-to-1, so I already removed risk from the table, but I give myself the opportunity to be able to make a bit more if this one stays the way it is and I end up expiring above that strike price. So this is again goes to how we manage our opportunities. What do we do once the market is already in our favor and there's a couple of hours or a couple of minutes to go for that opportunity? Okay, so couple of options for you there. All right, any questions about that? Okay, I'm glad everything's clear. Okay, so I want to talk a little bit about the benefits of trading with Nadex. So we're a little bit ahead of time right now. Oh, there's questions. Are there more videos on the subject? Which subject, of crude oil and natural gas, or the trading strategies? Because we do have different topics. So we're looking at how to trade index market, we're looking at agricultures. There's some more videos on live webinars really about binaries, about spreads, and also the advanced course, which is the trading strategy in itself, and also how to utilize it using Nadex contracts. Of that you were just going over, adjusting trade to prevent loss. So we're talking about that in the advanced course. So this is really part of managing trades. I gotta tell you, this can be, you know, sometimes people think that finding an opportunity is the hardest thing, but it's not just that. It's also managing your trade correctly. The worst thing ever is when you have a winning trade and by wrong action you turn it into a losing trade, or a trade that didn't earn you as much as it should. Because the trades that goes to stop, they end up in a stop. We somehow let them run. But the one that you know, are profitable for us, we need to be very clever in what we do, because we don't want to take a nice winning trade and just because we left it too long or we didn't take action, we turn it into a losing trade. So the scaling out, this is what I was referring to, is one of the ways to do that. It allows you to be in a risk-free trade while being able to get a little bit more out of that opportunity. It wouldn't get the entire stake that you have on the higher expiry, because, or the higher amount I should say, because half of it is not the full amount. However, it's more protected. So if you think about the win-loss ratio, right? Let's say I've got six winning trades and 4 losing trades, and let's say all of them are just 1-to-1 for simplicity. If I take one of those losing trades, so it means at the end of this exercise, I've got 2%, right? So 6 winning, 4 losing, 2% gain. Now, if I take one of those losing trades and I've turned it into a break-even trade, Okay, so I didn't do anything different. I didn't get more winning trades. I just turned a losing trade into a break-even trade by utilizing the scaling out. So now I have 3% loss and still 6% gain. Now I'm up 3%. So by not taking a losing trade, I actually increased the end result on my account. So it's not just about finding more and more winning trades. It's about managing our trades correctly to reduces the amount of the losing trades and just into a break even. So that didn't give me anything, but it also didn't take away from my account. So by looking at the bottom line, it can actually increase our bottom line. So by scaling out, it gives me a better chance at reward to risk at the end of the day. So we talk about that a bit more, and we show more examples in the advanced course, because once we teach the strategies themselves, we can talk a little bit more about where would be the right place, or a better place, let's put it this way, to put our target. So where exactly would I go with that target and all that. Is it possible to set alarm on Nadex platform to notify you, for example, a cross happen on the EMA or MACD indicators? I know this is possible on the Ninja traders. I don't think there is alarms on that, but I also don't look at EMA crossover or MACD crossovers, because to us, these are very lagging indicators. What we want to do, we want to predict the market, and so I'd like to be able to see what have a higher likelihood of happening in the market next. Okay, so for that reason, we don't look at crossover, because crossover calculated on historical price action. What we do with the MACD is we're looking for convergence and divergence, so giving us likelihood of the strength of the trend. So more information about that on the advanced course. But to answer your question, I don't think there is alert on that. If not, can you suggest a free chart service that has alert? I don't think that I can. So I don't think that I'm allowed to. I don't know how this whole thing, I think that's not going to be, okay. I would suggest that you have a good search around what is the correct thing that would be better for you. Mind you, for entry into the market, you do need to look at the Nadex chart, because you do need the pricing. So they might be different from whatever other service you are using. I don't know about great free chart service, so I can't help you with that, but have a look at the internet, see if there's anything that take your fancy. But whatever chart package that you're using, have a look at the charts on Nadex himself. Have a look at the pricing, because you want to get the correct pricing for your opportunity. Does scaling out mean closing the trade? So scaling out mean that I close part of the trade. Okay, I don't close all of the trade. So if, say for example, I opened a position, say my risk, let's give a concrete example. So let's say my risk is $100 per trade. So scaling out means that I would close $50 worth of my trade at 1-to-1, and I let the other 50 run for the next target. Sometimes the way to do that, by the way, is to open two different tickets. So one of the things that I like to do is actually take two different expiry prices, so two different tickets. I'll put the $50 on a ticket that would have basically an expiry that would give me a 1-to-1, and then the second one would be, say, a 2-to-1 or a 3-to-1, or whatever good place in the chart that offer me a place to say, right, the market have a higher likelihood of getting there. I'm quite confident it will. This would be my next target. So it's two different tickets altogether. So scaling out basically means closing out of part of your position. Okay, don't confuse it. I heard that before. Someone was confusing it with doubling in. So that's not it. This is not entering on lower prices as the market goes against you. That's absolutely not it. This is exiting. So we enter in the tickets at the same time, but we are exiting them in different times, in different pricing. Okay. Yes, okay, cool. Um, Sorry, I've got a comment. Have been having trouble setting a take profit on the ES. Okay, so the S&P, yes. I think if you find it a little bit hard, if you don't know how to work out the platform, two things that I would recommend. I would recommend have a look at the demo and play with the demo so you don't feel like this is your hard-earned money that you're about to lose if you did some technical mistake. So play with the demo, put in. So what you do, you enter into an opportunity, and then you put in basically to exit an opportunity as a take profit. Say you bought into that market, you need to sell that market at a certain price. So you put it in an order. Say, for example, let's take an example with numbers. Say you bought the market at $40, a 1-to-1 would be 80. So you put in an order to sell that option at 80 bucks. So when this option rise into 80, it would actually enter you into the other side, so it would sell you out of that position. Make sense? So that's how you take profit. Play with it on the demo. And if you still have issues, I would suggest give Nadex a call because you really want to be able to utilize the strength of that platform to your advantages. Okay, so you don't want to, just because you don't know how to do it, you missed on your profit. So if it doesn't work, if you're still having issues with the demo, give a Nadex a call. I'm sure they'll be very happy to help you. All right, so Nadex offer us a fantastic way to trade the world's commodities, giving us this unique vehicle of spreads and binaries. Now, you got this protection from market spikes. Let me tell you a situation that happened for me. So I was on a trade on dollar yen, and there was out of the blue, without any kind of warning whatsoever. The trade, by the way, was winning. Everything was looking great. It reversed on me because there was an intervention. And it didn't reverse on me, 1 or 2 points. It slammed down. Like, it was unbelievable. Within seconds, it was over 100 pips below where, so my trade was nicely in profit, and it was completely below that, like massive candle, massive. So when you look at that, if I was in the traditional sorts of trading, oh, I will be bleeding at that time. But it didn't matter. It didn't matter if I lost by 5 points or by 5,000 points. Didn't matter. My risk stayed the same. So huge protection from this kind of market adversity and spikes as well. So you don't get stopped out when the market spikes against you, and this can happen quite a lot. We also get opportunities in flat markets. So in order to make money in the market, we need the market to move. But we don't necessarily need that with the binaries. We can actually get a nice one-to-one with having the market moving slightly or staying really where it is right now. All I need is the market to not move much, and I get my one-to-one. It's a fantastic way of benefiting from sideways market. We're also looking at range-bound markets, so we look at the top part and the bottom part of the range and expecting the support and resistance level to hold and the market react to it and continue into the other side of that range. So there's a wide range of contract that can suit your trading style, and you can choose from a very short-term contract to a longer-term contract, and your fees are capped. So they are 90 cents per contract, and it's capped at $9 per order. It's fully regulated, so it's regulated by the CFTC. And you've got an exclusive trader training program with us, the team at Trade with Precision, and it's completely free to all Nadex members. So what it is, it's a 4.5 hours of webinars, live webinar. It's delivered over 3 weeks. What we do there, we cover in a bit more length and also more details all the technical ingredients that we are looking at. So we only saw 4 today, but there are more to add into that. And remember, every layer, every ingredient is there to increase the probabilities of our opportunity reaching target. Now, we're also going to look a bit about trader mindset. It's very important to understand how to think in probabilities. We're also going to take all of that ingredients that we talked about and the risk management and all that and put it together into two complete trading strategies. So what I'm going to do, I'm going to actually give you the rules for those trading strategies, so you will know exactly if this and this tick all the boxes, then there's a higher likelihood of a good opportunity there. But if something is not there, off I go to the next chart because it's not there. It's not supported by the set of rules. So it's take that guessing part out of trading. It's when we look at a trading strategy, we look at flawlessly executing that rules of this trading strategy in order to have an edge in the market. And even if you have your own trading strategies that you're trading, you know what? It's always helped to add something else into it. It might help to refine your strategy a bit better or add something to increase your win-loss ratio. It's a good idea to sit and hear something that could add to your own way of trading. In part 3, what we're going to do, we're going to see the binaries and spread in action. So we're going to take all that information, everything that we've learned, and we go example by example, which tickets make sense to choose and why, depending on how long I've got until expiry, all sort of things like that, all those questions that comes in managing our trade and entering a position and how long and what time frame and how do I know which expiry to choose. We're going to look at all of these with concrete examples, at trades from start to finish, to have a look at that. We also have live trading webinars utilizing those trading strategies, and I think they're going to be about an hour and half an hour before market open, so we can get to analyze all the, so before the index market open, obviously. So we get to analyze the charts and what sort of opportunities, and if there's something interesting, jump into the chart and look at example of what tickets I'm looking at, what's interesting to me, and all that. When do these trading strategy classes start? Let me tell you. Let me have a look for you. Just a second. So we've got that. All right, so the first session is going to start on the 8th of June. At the same time for you as this one has started, depending where you are. So it's going to be the 8th of June at the same time. And then the next week, and it's going to be week after week, but the next week it's going to be a day after. So it's going to start on the 16th, and then the, let me see, and then the 23rd. Okay, so the first session is on the 8th. It's starting, and we also have this as a live trading, and we also have different topics as well. So let me have a look what else we've got for you. So we've got I think there is euro dollar. There's introduction to spreads in about 2 weeks time, if you're interested to understand more about the spreads. And then the next one is the advanced. Yes, so there are a couple of them. Look, I really suggest you have a look at the calendar on the website. You'll see all the webinars that are out there. But the advanced classes, they will start on the 8th of June on the time that this one has started for you. So if you're interested to take your trading to the next level with Nadex and trade with precision, visit Nadex on the website, give them a call or email them for any further questions. Very simple 5 steps to open an account. And as I said, play with the demo as well. Really, really important, so you know what you're doing before you're risking your own money. I think this is a fantastic thing that Nadex also give us a demo account to play with. Okay, we've reached the end of our presentation. If there's any questions, I'm very happy to answer them. Whatever topic that you find a little bit unclear, very happy to answer. I am a Nadex client. Where can I sign up for the training? I believe you can do that via the website, or you can phone Nadex, or send them an email, say that you want to participate in the advanced course. It's a really fantastic opportunity, I think, because what it gives you is just a bit more information about technical analysis and technical ingredients, and how we kind of combining all of those ingredients together. How do we look at the chart? And then when we do the live session, you can see all of that in action as well. So how it's one thing in theory, it's very different when you see it in action too. Um, So regarding the demo, about how long can I use the demo once I begin using it? Sorry, I think you've got, there is a limitation, I think, on that time. I'm not sure, but someone also mentioned to me that as long as you have an open account, because my demo is still there, so as long as you've got an open account, then you can use the demo account as well. So I think you either need to mention it, but I think once you've got an open account, you can also have that. Thanks, Miss Tamar. Awesome as usual. Thank you. Thank you very much. I'm really happy that you enjoyed it, and I'm very happy that you find it useful. Look, lately Crude has been just fantastic. So great opportunities there, but very important to wait for the opportunities, to not jump into the market straight away. Even if you know it's going to bounce off there, you need the reason to enter. You need a signal, you need a trigger. Very well done. Thank you. I learned a lot. That's great. Thank you. Great webinar and very informative. Thank you so much. That is fantastic to hear. I'm really glad that you enjoyed it. I see that there's no more questions. So thank you, everybody. Have a fantastic weekend. Well done. Thanks. And I'll see you on the next webinar, which I think is the spreads one. So if you want to hear more about spreads, it's a good place to be, and on the advanced course. Fantastic. Happy trading. Bye for now.